Open a ZERODHA account. 5 Options Theory for Professional Trading Chapter 1. Call Option Basics Chapter 2. Basic Option Jargons Chapter 3. Buying a call option Chapter 4. Selling, writing a call option Chapter 5. The put option buying Chapter 6. The put option selling Chapter 7. Summarizing call and put options Chapter 8. Moneyness of an option contract Chapter 9. The option Greeks, Delta, Part 1 Chapter 10. Delta, Part 2 Chapter 11. Delta, Part 3 Chapter 12. Gamma, Part 1 Chapter 13. Gamma, Part 2 Chapter 14. Theta Chapter 15. Volatility Basics Chapter 16. Volatility Calculation Historical Chapter 17. Volatility and Normal Distribution Chapter 18. Volatility Applications Chapter 19. Vega Chapter 20. Greek Interactions Chapter 21. Greek Calculator Chapter 22. Reintroducing call and put options Chapter 23. Case studies, wrapping it all up. Download. Taki cannot access the selected text from this type of page. It is a very special page. Open a ZERODHA account. Chapter 1. Call Option Basics. Hindi Gujarati. 1.1 Breaking the Ice. As with any of the previous modules in Varsity, we will again make the same old assumption that you are new to options and therefore know nothing about options. For this reason, we will start from scratch and slowly ramp up as we proceed. Let us start with running through some basic background information. The options market makes up for a significant part of the derivative market, particularly in India. I would not be exaggerating if I were to say that nearly 80% of the derivatives traded are options, and the rest is attributable to the futures market. Internationally, the option market has been around for a while now. Here is a quick background on the same. Custom options were available as over-the-counter OTC since the 1920s. These options were mainly on commodities. Options on equities began trading on the Chicago Board Options Exchange (CBOE) in 1972. Options on currencies and bonds began in late 1970s. These were again OTC trades. Exchange-traded options on currencies began on Philadelphia Stock Exchange in 1982. Interest rate options began trading on the CME in 1985. Clearly, the international markets have evolved a great deal since the OTC days. However, in India from the time of inception, the options market was facilitated by the exchanges. However, options were available in the off-market BADLA system. Think of the BADLA system as a gray market for derivatives transactions. The BADLA system no longer exists. It has become obsolete. Here is a quick recap of the history of the Indian derivative markets. June 12, 2000 Index futures were launched. June 4, 2001 Index options were launched. July 2, 2001 stock options were launched. November 9, 2001 single stock futures were launched. Though the options market has been around since 2001, the real liquidity in the Indian index options was seen only in 2006. I remember trading options around that time. The spreads were high and getting fills was a big deal. However, in 2006, the Ambani brothers formally split up and their respective companies were listed as separate entities. thereby unlocking the value to the shareholders. In my opinion, this particular corporate event triggered vibrancy in the Indian markets, creating some serious liquidity. However, if you were to compare the liquidity in Indian stock options with the international markets, we still have a long way to catch up. 1.2a Special Agreement. There are two types of options, the call option and the put option. You can be a buyer or seller of these options. Based on what you choose to do, the P&L profile changes. Of course, we will get into the P&L profile at a much later stage. For now, let us understand what the call option means. In fact, the best way to understand the call option is to first deal with a tangible real-world example. Once we understand this example, we will extrapolate the same to stock markets. So let's get started. Consider this situation. There are two good friends, Ajay and Venu. Ajay is actively evaluating an opportunity to buy 1 acre of land that Venu owns. The land is valued at 500,000 rupees per. Ajay has been informed that in the next 6 months, a new highway project is likely to be sanctioned near the land that Venu owns. If the highway indeed comes up, the valuation of the land is bound to increase, and therefore Ajay would benefit from the investment he would make today. However, if the highway news turns out to be a rumor, which means Ajay buys the land from Venu today and there is no highway tomorrow, then Ajay would be stuck with a useless piece of land. So what should Ajay do? Clearly, this situation has put Ajay in a dilemma, as he is uncertain whether to buy the land from Venu or not. While Ajay is muddled in this thought, Venu is quite clear about selling the land if Ajay is willing to buy. Ajay wants to play it safe. He thinks through the whole situation and finally proposes a special structured arrangement to Venu, which Ajay believes is a win-win for both of them. The details of the arrangement is as follows. Ajay pays an upfront fee of 100,000 rupees per today. Consider this as a non-refundable agreement fees that Ajay pays. Against this fees, Venu agrees to sell the land after 6 months to Ajay. The price of the sale, which is expected 6 months later, is fixed at 500,000 rupees per, because Ajay has paid an upfront fee. Only he can call off the deal at the end of 6 months if he wants to, that is. Venu cannot. In the event Ajay calls off the deal at the end of 6 months, Venu gets to keep the upfront fees. So what do you think about this special agreement? Who do you think is smarter here? Is it Ajay for proposing such a tricky agreement, or Venu for accepting such an agreement? Well, the answer to these questions is not easy to answer unless you analyze the details of the agreement thoroughly. I would suggest you read through the example carefully. It also forms the basis to understand options. Ajay has plotted an extremely clever deal here. In fact, this deal has many phases to it. Let us break down Ajay's proposal to understand some details. By paying an agreement fee of 100,000 rupees per, Ajay is binding Venu into an obligation. He is forcing Venu to lock the land for him for the next 6 months. Ajay is fixing the sale price of the land based on today's price, i.e. 500,000 rupees per, which means irrespective of what the price would be 6 months later, he gets to buy the land at today's price. Denote: he is fixing a price and paying an additional 100,000 rupees per today at the end of the 6 months. If Ajay does not want to buy the land, he has the right to say no to Venu. But since Venu has taken the agreement fee from Ajay, Venu will not be in a position to say no to Ajay. The agreement fee is non-negotiable, non-refundable. Now, After initiating this agreement, both Ajay and Venu have to wait for the next 6 months to figure out what would actually happen. Clearly, the price of the land will vary based on the outcome of the highway project. However, irrespective of what happens to the highway, there are only 3 possible outcomes. Once the highway project comes up, the price of the land would go up. Say it shoots up to 10 rupees. The highway project does not come up. People are disappointed. The land price collapses, say to 300,000 rupees per. Nothing happens. Price stays flat at 500,000 rupees per. I'm certain there could be no other possible outcomes that can occur apart from the 3 mentioned above. We will now step into Ajay's shoes and think through what he would do in each of the above situations. Scenario 1: price goes up to 10 rupees. Since the highway project has come up as per Ajay's expectation, the land price has also increased. Remember, as per the agreement, Ajay has the right to call off the deal at the end of 6 months. Now, with the increase in the land price, do you think Ajay will call off the deal? Not really, because the dynamics of the sale are in Ajay's favor. Current market price of the land equals 10 rupees. Sale agreement value equals 500,000 rupees per. This means Ajay now enjoys the right to buy a piece of land at 500,000 rupees per when in the open market. The same land is selling at a much higher value of 10 rupees. Clearly Ajay is making a steal deal here. Hence he would go ahead and demand Venu to sell him the land. Venu is obligated to sell him the land at a lesser value, simply because he had accepted 100,000 rupees per agreement fees from Ajay 6 months earlier. So how much money is Ajay making? Well, here is the math. Buy price equals 500,000 rupees per. Add agreement fees equals 100,000 rupees per. Remember, this is a non-refundable amount. Total expense equals 500,000 plus 100,000 equals 600,000. Current market of the land equals 10 rupees. Hence his profit is 10 rupees. 600,000 rupees equals 400,000 rupees per. Another way to look at this is, for an initial cash commitment of 100,000 rupees per, Ajay is now making 4 times the money. Venu, even though very clearly knows that the value of the land is much higher in the open market, is forced to sell it at a much lower price to Ajay. The profit that Ajay makes, 400,000 rupees per, is exactly the notional loss that Venu would incur. Scenario 2: price goes down to 300,000 rupees per. It turns out that the highway project was just a rumor, and nothing really is expected to come out of the whole thing. People are disappointed, and hence there is a sudden rush to sell out the land. As a result, the price of the land goes down to 300,000 rupees per. So what do you think Ajay will do now? Clearly it does not make sense to buy the land. Hence he would walk away from the deal. Here is the math that explains why it does not make sense to buy the land. Remember, the sale price is fixed at 500,000 rupees per 6 months ago. Hence if Ajay has to buy the land, he has to shell out 500,000 rupees per, plus he had paid 100,000 rupees per towards the agreement fees, which means he is in effect paying 600,000 rupees per to buy a piece of land worth just 300,000 rupees per. Clearly this would not make sense to Ajay. Since he has the right to call off the deal, He would simply walk away from it and would not buy the land. However, do note, as per the agreement, Ajay has to let go of 100,000 rupees per, which Venue gets to pocket. Scenario 3, price stays at 500,000 rupees per. For whatever reasons, after 6 months the price stays at 500,000 rupees per and does not really change. What do you think Ajay will do? Well, he will obviously walk away from the deal and would not buy the land. Why, you may ask? Well, here is the math. Cost of land equals 500,000 rupees per. Agreement fee equals 100,000 rupees per. Total equals 600,000 rupees per. Value of the land in open market equals 500,000 rupees per. Clearly it does not make sense to buy a piece of land at 600,000 rupees per when it is worth 500,000 rupees per. Denote. Since Ajay has already committed 1 LK, he could still buy the land, but ends up paying 1 rupee LK extra in this process. For this reason, Ajay will call off the deal and in the process let go of the agreement fee of 100,000 rupees per, which Venue obviously pockets. I hope you have understood this transaction clearly. And if you have, then it is good news, as through the example you already know how the call options work. But let us not hurry to extrapolate this to the stock markets. We will spend some more time with the Ajay Venue transaction. Here are a few Q&As about the transaction which will throw some more light on the example. Why do you think Ajay took such a bet even though he knows he will lose his 1 lakh if land prices does not increase or stays flat? Agreed, Ajay would lose 1 lakh. But the best part is that Ajay knows his maximum loss, which is 1 lakh beforehand. Hence there are no negative surprises for him. Also, as and when the land prices increases, so would his profits, and therefore his returns. At 10 rupees, he would be making 400,000 rupees per profit on his investment of 100,000 rupees per, which is 400%. Under what circumstances would a position such as Ajay's make sense? Only that scenario when the price of the land increases. Under what circumstances would Venue's position make sense? Only that scenario when the price of the land decreases or stays flat. Why do you think Venue is taking such a big risk? He would lose a lot of money if the land prices increases after 6 months, right? Well, think about it. There are only 3 possible scenarios, out which 2 indeed benefit Venue. Statistically, Venue has 66.66% chances of winning the bet as opposed to Ajay's 33.33% chance. Let us summarize a few important points now. The payment from Ajay to Venue ensures that Ajay has a right, remember only he can call off the deal, and Venue has an obligation, if the situation demands. He has to honor Ajay's claim. The outcome of the agreement at termination, end of 6 months, is determined by the price of the land. Without the land, the agreement has no value. Land is therefore called an underlying and the agreement is called a derivative. An agreement of this sort is called an options agreement. Since Venue has received the advance from Ajay, Venue is called the agreement seller or writer, and Ajay is called the agreement buyer. In other words, since this agreement is called an options agreement, Ajay can be called an options buyer and Venue the options seller, writer. The agreement is entered after the exchange of 1 lakh. Hence 1 lakh is the price of this option agreement. This is also called the premium amount. Every variable in the agreement area of the land, price and the date of sale is fixed. As a thumb rule, in an options agreement, the buyer always has a right and the seller has an obligation. I would suggest you be absolutely thorough with this example. If not, Please go through it again to understand the dynamics involved. Also, please remember this example. As we will revisit the same on a few occasions in the subsequent chapters. Let us now proceed to understand the same example from the stock market perspective. 1.3 The call option. Let us now attempt to extrapolate the same example in the stock market context with an intention to understand the call option. Denote. I will deliberately skip the nitty-gritty of an option trade at this stage. The idea is to understand the bare-bone structure of the call option contract. Assume a stock is trading at 67 rupees per today. You are given a right today to buy the same 1 month later. It's say Rs. 75. But only if the share price on that day is more than Rs. 75. Would you buy it? Obviously you would. As this means to say that after 1 month, even if the share is trading at 85, you can still get to buy it at 75 rupees. In order to get this right, you are required to pay a small amount today, say 5 rupees per. If the share price moves above Rs. 75, you can exercise your right and buy the shares at Rs. 75. If the share price stays at or below Rs. 75, you do not exercise your right and you do not need to buy the shares. All you lose is Rs. 5 in this case. An arrangement of this sort is called option contract. A call option, to be precise. After you get into this agreement, there are only 3 possibilities that can occur. And they are: the stock price can go up, say 85 rupees per. The stock price can go down, say 65 rupees per. The stock price can stay at 75 rupees per. Case 1: if the stock price goes up, then it would make sense in exercising your right and buy the stock at 75 rupees per. The P&L would look like this. Price at which stock is bought equals 75 rupees. Premium paid equals Rs. 5. Expense incurred equals 80 rupees. Current market price equals 85 rupees. Profit equals 85 to 80 equals 5 rupees per. Case 2: if the stock price goes down to say 65 rupees per, obviously it does not make sense to buy it at 75 rupees per, as effectively you would spending 80 rupees per 75 plus 5 for a stock that's available at 65 rupees per in the open market. Case 3: likewise, if the stock stays flat at 75 rupees per, it simply means you are spending 80 rupees per to buy a stock which is available at 75 rupees per. Hence you would not invoke your right to buy the stock at 75 rupees per. This is simple, right? If you have understood this, you have essentially understood the core logic of a call option. What remains unexplained is the finer points, all of which we will learn soon. At this stage, what you really need to understand is this, for reasons we have discussed so far. Whenever you expect the price of a stock, or any asset for that matter, to increase, it always makes sense to buy a call option. Now that we are through with the various concepts, let us understand options and their associated terms. Variable J, venue transaction, stock example remark. Underlying 1 acre land stock. Do note the concept of lot size is applicable in options. So just like in the land deal where the deal was on 1 acre land, not more or not less. The option contract will be the lot size. Expiry 6 months, 1 month. Like in futures, there are 3 expiries available. Reference price 500,000 rupees per 75 rupees per. This is also called the strike price. Premium 100,000 rupees per 5 rupees per. Do note in the stock markets, the premium changes on a minute-by-minute basis. We will understand the logic soon. Regulator none. Based on good faith stock exchange, all options are cash settled. No defaults have occurred until now. Finally, before I end this chapter, here is a formal definition of a call options contract. The buyer of the call option has the right, but not the obligation, to buy an agreed quantity of a particular commodity or financial instrument, the underlying, from the seller of the option at a certain time, the expiration date, for a certain price, the strike price. The seller, or writer, is obligated to sell the commodity or financial instrument should the buyer so decide. The buyer pays a fee, called a premium, for this right. In the next chapter we will look into a few finer details with regard to the call option. Key takeaways from this chapter. Options are traded in the Indian markets for over 15 years. But the real liquidity was available only since 2006. An option is a tool for protecting your position and reducing risk. A buyer of the call option has the right, and the seller has an obligation to make delivery. The option is only given to one party in the transaction, buyer of an option. The option seller is also called the option writer. At the time of agreement, the option buyer pays a certain amount to the option seller. This is called the premium amount. The agreement happens at a pre-specified price, often called the strike price. The option buyer benefits only if the price of the asset increases higher than the strike price. If the asset price stays at or below the strike, the buyer does not benefit. For this reason, it always makes sense to buy options when you expect the price to increase. Statistically, the option seller has higher odds of winning in a typical option contract. The directional view has to pan out before the expiry date, else the option In the previous chapter, we understood the basic call option structure. The idea of the previous chapter was to capture a few essential call option concepts such as: it makes sense to be a buyer of a call option when you expect the underlying price to increase. If the underlying price remains flat or goes down, then the buyer of the call option loses money. The money the buyer of the call option would lose is equivalent to the premium agreement fees the buyer pays to the seller, writer of the call option. In the next chapter, i.e., Call Option, Part 2, we will attempt to understand the call option in a bit more detail. However, before we proceed further, let us decode a few basic option jargons. Discussing these jargons at this stage will not only strengthen our learning, but will also make the forthcoming discussion on the options easier to comprehend. Here are a few jargons that we will look into. Strike price, underlying price, exercising of an option contract, option expiry, option premium, option settlement. Do remember, since we have only looked at the basic structure of a call option, I would encourage you to understand these jargons only with respect to the call option. Strike price. Consider the strike price as the anchor price at which the two parties, buyer and seller, agree to enter into an options agreement. For instance, in the previous chapters, a J venue example, the anchor price was 500,000 rupees per, which is also the strike price for their deal. We also looked into a stock example where the anchor price was 75 rupees per, which is also the strike price. For all call options, the strike price represents the price at which the stock can be bought on the expiry day. For example, if the buyer is willing to buy ITC Limited's call option of 350 rupees, 350 being the strike price, then it indicates that the buyer is willing to pay a premium today to buy the rights of buying ITC at 350 rupees on expiry. Needless to say, he will buy ITC at 350 rupees only if ITC is trading above 350 rupees. In fact, here is a snapshot from NSE's website where I have captured different strike prices of ITC and the associated premium. The table that you see above is called an option chain, which basically lists all the different strike prices available for a contract along with the premium for the same. Besides this information, the option chain has a lot more trading information such as open interest, volume, bid-ask quantity, etc. I would suggest you ignore all of it for now and concentrate only on the highlighted information. The highlight in maroon shows the price of the underlying in the spot. As we can see, at the time of this snapshot, ITC was trading at 336 rupees and 90 paise per share. The highlight in blue shows all the different strike prices that are available. As we can see, starting from 260 rupees with 10 rupees intervals, we have strike prices all the way up to 480 rupees. Do remember, each strike price is independent of the other. One can enter into an options agreement at a specific strike price by paying the required premium. For example, one can enter into a 340 call option by paying a premium of 4 rupees and 75 paise per, highlighted in red. This entitles the buyer to buy ITC shares at the end of expiry at 340 rupees. Of course, you now know under which circumstance it would make sense to buy ITC at 340 at the end of expiry. Underlying price. As we know, a derivative contract derives its value from an underlying asset. The underlying price is the price at which the underlying asset trades in the spot market. For example, in the ITC example that we just discussed, ITC was trading at 336 rupees and 90 paise per in the spot market. This is the underlying price. For a call option, the underlying price has